So there's two parts of our company. We bought some car washes and dental offices, but mainly car washes for massive depreciation and very consistent cash flow for a lot of our high net worth investors. And for those that know what they're doing, we think that it's the best we've seen in at least the last 7 to 10 years. And we'll know in the next 5 if this is like a 2012. But multifamily has been through some major pain over the last 4 years, and that major pain of deals that were bought in 21 and 22 are now at the market, and they're coming in at a huge, huge discount compared to what they paid for it 5 years ago.
All right, welcome Real Estate Hustlers podcast. I'm your host, Josh Appelman. Today we're joined with Dan Brisse. Dan is the co-founder and managing partner of Granite Towers Equity Group, leading acquisitions and investor relations, former X Games gold medalist, brings elite discipline to multifamily investing. Dan, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, Josh, great. Thanks for having me. Grateful to be here with you. Yeah, so my story, I grew up in a small town in Minnesota, and like a lot of your listeners, I had big dreams as a kid, and I wanted to be this professional snowboarder. So I go out and start telling everyone about how I'm going to be this big time athlete, and a lot of teachers and a lot of friends start asking how I'm going to do it. And being young, I don't really know how actually at all. And so I had two great leaders in my life, though, at a young age. One of them said, go for it. And the other one said, do what you love. And those were my parents. And, quick note I would just say is for parents that are listening, for kids, you just never could know the level of desire that your kid may develop for something. And I sure didn't know that for me. So I started snowboarding every day in Minnesota from 9th grade to my senior year. When I graduated from high school, I moved to Salt Lake City. I thought within 1 year, I'm going to be this big name pro snowboarder. And mind you, my parents supported me tremendously, but they didn't have any financial assistance. So I'm literally paycheck to paycheck, eating peanut butter and jelly for breakfast, lunch, and dinner, working at Blockbuster at night, snowboarding during the day. After a year being in Salt Lake City, I think I'm going to be this big name guy. Nothing happens. Go back home, save some money, come back year 2. I think this is my year, eating peanut butter and jelly, working at Red Lobster. Nothing happens. Year 3, I come back out and I end up dislocating my kneecap and needed knee surgery. I tore my meniscus. And this would be the point where if I wasn't committed to being an athlete, I definitely would have hung it up right here. But instead, I moved to Venice Beach and I went through my knee biking on the beach. And my brother lived out there. Came back year 4, and a really good friend of mine that lived in Salt Lake City says, hey, Dan, you're good. You should go to Aspen, Colorado to compete in the Aspen Open. And I politely tell him I'd love to go, but you know me, I'm living paycheck to paycheck working at, these odd jobs. And so he ends up paying for me to go there, takes me to Aspen, checks me into the contest, pays for the hotel. And when I get there, there's 225 up and coming youngsters or athletes from around the world. And it's entry fee to get in, couple $100. You get 2 runs. If you do well, you go to finals. I ended up finishing 6th in qualifiers, come back the next day. I don't know what happened to everybody else, and ended up winning this contest. And the brands who had been supporting me for a few years took note and said, hey, we heard about Aspen, saw it. It was on TV. It was aired as a television event. And they brought me to events where a lot of the brand managers that ran the industry were located, and I would show up, and I had 2-3 events, and within 2-3 of those events of them seeing me and meeting me in person, I ended up signing like 5 contracts. So I had this 15-year run as a professional snowboarder. I was in X Games 6 times. I was on the cover of almost every snowboard magazine, and it was phenomenal. And the part I would say, Josh, that really blew me away was when I got to the top and I met a lot of my peers or like heroes, and they became my friends. They were 5 or 10 years in front of me. When I saw them wind down, it was super scary. So that's a little bit about me. And then I've transitioned into real estate. We can go wherever you want from there.
Yeah, well, they a lot of people just see you in the X Games and winning. They don't see the grind, the hustle, the grit, and to get to where you're at. They just see the win, and then they forget that the really the only ingredient to success is showing up every single day and consistently showing up, and that's really truly the magic recipe. Plus, having a burning desire to get to where you're going, and that why. Once you find out that why, that intense desire, I mean, that's the most powerful thing that I think anybody can have if they take the time to find it.
Yeah.
So very, that's an inspiring story. That's really cool. And it just kind of, it shows your character too. And that can go into real estate, because real estate can give you a uh, whole new dimension. And let's get into that. You've seen the, I'm not going to say the downfall of some of your peers, but what happens when the sponsors stop sponsoring, the money stops flowing,
Yeah.
and then all the hard work kind of goes away, or in a physical sense, because the cash flow stops flowing. So tell us about that.
Yeah, that was extremely eye-opening for me. I'm an average guy. I did decent in school. I got A's and B's, but I didn't have this big college degree to fall back on. So as I'm in the peak of my career and I'm winning gold medals and I'm getting paid really well compared to where I came from, the guys who are 5 or 10 years in front of me are getting cut, and their homes are being taken away. Their cars are being taken away. They're getting divorced, suicides happening. And when I'm seeing this real time, I'm just thinking, if I'm lucky enough to have a career as long as these guys, and I can be as popular and make as much as they did for their career, I'm gonna be lucky. And so at that point in time, I immediately started to read every book I could get my hands on what to do with the money I was making. One thing I would just share that I wish I would have heard at an earlier age is making money is only 50% of it. What are you going to do with it? How are you going to take that capital and start to have it pay you every month, whether you work or don't work? So that's the realization, the light bulb moment for me is I got to get the capital I'm making invested into real assets that will cash flow. And, another piece that hit me really hard I never heard about is what quadrant I'd be in as a professional athlete. I'm in the S quadrant, and the S quadrant gets hammered on taxes. So here I've risked my life, sacrificed everything, gone through some serious challenges. And all of a sudden, year one, I start making a heavy 6-figure income, and almost half of it's due to be paid for taxes. And so at that moment in time, I started going down this path of how can I get a great CPA on my team? And the CPA I had was not the right guy to advise me on what to do with the capital. He was IRAs, he was all this, hokey stuff that wasn't going to get it done. And so I finally find a great team member out of Arizona, Provision, and they say, yeah, you need to start buying real estate. And my wife was working at the restaurant, and they're like, hey, you can get your wife to be a real estate professional, and you can start taking some major depreciation. So the lesson I learned is passive income is huge. It's critical. It's needed. I wanted to hedge inflation because I could already see them printing an incredible amount of money after the Great Recession, through QE1 through 4, and then depreciation. So those are the three things that I learned that changed my life forever. And they're really the three things that I'm still focused on to this day, whenever we're doing any sort of multifamily deal.
What year did you get started in real estate?
So the first year that I bought multifamily was in 2012, and it was a duplex.
Yeah.
And that the criteria for that was cash flow, hedging the dollar, and depreciation, and those offered it.
That's huge. And then you seen where cash was going, and you got in at a really good time too.
Yeah,
Well,
did.
tell us about the first deal. We can step in there, and then, because that's your experience.
Yeah, you bet. I started small, and mind you, as a listener, you don't need to start small. But the reality is 70% of all pro athletes are broke by the time within 3 years. And so for me, I'm like, okay, while the career is going on, let's get going. So passive income, again, I don't know the level of your education of your listeners, but the basics is real simple, is that when I'm sleeping, when I'm at home, when I'm on vacation, I got my money working for me and I'm getting paid. And whether I work or don't work, I get paid. And, for me, I could see an end coming as I'm seeing these guys, as I'm riding up the chairlift one day at Mount Hood. The reality is that I'm just a light bulb moment goes off, is that I'm going to get cut. And when that does happen, how can I make the transition totally smooth where I'm a snowboarder and now I'm not, and nothing changes? So that was my goal. So I ended up buying a duplex. And this duplex, I think I only put like 25 grand into my first deal. Again, I started small. You don't need to start this small. I wouldn't start with this asset again, but it was a nice 10% cash flowing deal. It was lucky to be for timing. At the end of the day, the biggest favor I had in my hat, Josh, is I was buying in 2012. It was literally the bottom of the Great Recession. And so had I bought that deal at the wrong time, that deal may not have done that well because it wasn't in a great location. It's not even close to the criteria we'd buy to today. It was just a very small deal. So, but it did cash flow, it did hedge inflation, and it helped me with depreciation. And it was far before we are what we are today. So it was not like we didn't develop a business plan. We didn't come in and do a bunch of capbacks. It was basically buy it, hold it, have a third party manager, and that was it.
Got it. And I'm thinking that's why you said you wouldn't do it again today with the third party management piece, because that's
Yeah.
where all the cash effectively goes on something that's small. There's just not economies of scale.
Yeah, I wouldn't do it. That's part of it. Bigger part is just the tenant profile that was living on site and the quality of the deal. Our criteria has transitioned to newer, nicer product. Now our criteria is really 150 units plus, B to B plus asset in an A location.
Are you all seeing those out there to where well, you're not doing value add, you're doing more coupon clipping, is that right?
Well, so there's two parts of our company. We bought some car washes and dental offices, but mainly car washes for massive depreciation and very consistent cash flow for a lot of our high net worth investors. And we have 3,300 units currently. And yeah, we are buying currently right now. I mean, we think there's a unique window buying opportunity that is back. And for those that know what they're doing, we think that it's the best we've seen in at least the last 7 to 10 years. And we'll know in the next 5 if this is like a 2012. But multifamily has been through some major pain over the last 4 years, and that major pain of deals that were bought in 21 and 22 are now at the market, and they're coming in at a huge discount compared to what they paid for it 5 years ago.
Yeah, no, I totally agree with that. My email box is getting more and more opportunities sent to them that I've ever seen. I haven't seen this much activity in, well, really the past 3 years. But I'm in Cincinnati, so I see value. I feel like there's still hope too that they're selling based on performa, and with just what I've seen so far. But that can change. Like there's still runway left, but there's opportunity.
Yeah, if you know a submarket really well, and a tenant profile or an asset class that you've got some experience with, where you've had some success on an exit, like for us, when we're buying stuff, cash flow is the number one piece of criteria we're looking for. And that may not be how all the firms are. That's just the way we're set up. And, passive income, like I said, back in 2012, for me was the holy grail of how do I just continue to increase many streams of income. So it gets to a point where when my real career as a snowboarder leaves, which it did, it was not painful. So yeah, there's more opportunity we're seeing now than for sure the last 3 or 4 years. And what's really happening is you've got owners that purchased in 21 and 22 that have bridge loans, that have had some deal fatigue, and now you're seeing more negotiations actually opening up because these folks they're tired of waiting for rates to come down. They've been waiting for 3-4 years, and now it's to the point of they're still not coming down. There isn't a huge sign like they're going to cut rates immediately. So you've got much more negotiation ability in the buy side, and there's much less people frenzying buying in. And now we're underwriting much more based off fundamentals, and so is the entire industry.
Yeah, based off in place NOI, not what it can be based on a property down the road that's doing what it's already doing. I think that was the most discouraging part of the past cycle is that everything's unviable unless you're willing to just go out and totally hose yourself.
Yeah.
And those are the ones that are just getting fried right now, getting totally burned.
Yeah, you bet. I mean, the big engine behind that was so many deals did so well from 2015 to 2021, and there was this turn of capital and capital gains that kept growing and building. And every time investors would get their money back, they'd have this huge capital gains bill, and they wanted more depreciation, so they get bigger and bigger chunks and keep throwing it into the next deal until obviously interest rates started to rise and the music stopped. And so now you've got a lot of capital that's been locked up in these deals, and a lot of it is unfortunately getting wiped out as these transitions happen to new purchases. We're buying a deal right now that is $6 million cheaper than what they paid for it back in 2022. That's, 2021. So it's 4 or 5 years ago, and now we have a $6 million discount. And it just shows that, if you have a great business plan in the right submarket, and you know your tenant profile, and you're sophisticated with a value add, it's really pretty basic to go and see what the competitors are doing. Like, what's your submarket competition doing today, and how are their finishes? How are their amenities? And then how can you implement that into your asset to be the diamond in the rough, right? How do you close on the deal, and 12 months later be the shiny object that everyone would want to live at, and base it based off of what's real time today? And when you're buying today, you're buying at elevated cap rates, expenses are higher, rents are lower, all good for purchase price for coming in on a cost basis.
Yeah, no, that's huge. So, $6 million discount from purchase price. You're working. Are they short selling? Is the bank taking a write down, or?
No, it's basically just the equity that's in the deal is
Okay.
we're going to go back to investors. So it's
Yeah.
more equity.
Yeah, that's unfortunate, but that's the game, and that's just the way it goes.
Yeah.
That's the way it is.
Yeah, when you had a bridge loan put in place, back in 21 or 22, and you've been feeding a deal for so long, there comes a point where you just can't keep feeding the deal, right? There's
Yeah.
the cost of the debt is draining everything you have, and the property begins to deteriorate because you're putting so much of the debt. And now the deferred maintenance starts to stack up, and people start leaving, and it's a downward spiral. So people have to get out.
Yeah, and they've got senior debt, mezz debt, preferred,
Yeah.
and I mean every kind of class of equity in there, and the
Yeah.
capital stack is
Yeah.
fighting against it.
Yeah, and now you can come in with a 7-year note, and I get it. Some people are going to say that's too risky, that's too long a debt. I want to go back to bridge, and that's fine for those that want to go that direction. But what we've decided is, let's just cover the downside risk. Let's just take the downside out and let the upside take care of these strong markets. This is a Plano, Texas deal, and location. I was just at it yesterday. I mean, phenomenal location. Whole Foods across the street. We ate at Flower Child. I mean, you can walk to it. So if you can buy this premier real estate, these premier locations right now at discounts with 7-year fixed debt, and come with a value add strategy that you can identify as working currently in that submarket, and you recreate it, I think you're at so much of a safer time, so much more sophisticated time to be out buying than, back in 21 and 22. And the quote that comes to my mind every day is, when I'm on a lot of these podcasts, is Warren Buffett talking about how when people are greedy, be fearful. And that was back in 2021, 2022.
Yeah.
And now when people are fearful, which is right now, be greedy.
Yeah, for sure. What are you seeing with new inventory coming online, absorption, and like stabilized occupancy? There's different parts of Texas where it's better and worse, just like anywhere else in the country.
Yeah, you bet. Obviously there was a ton of new starts back in when rates were low, and a ton of new supply has hit, and it really has affected the rental market, and it's dropped rent. I mean, we've had some negative rent growth over the last few years, and the majority of that supply in the submarkets we're buying in now has been eaten up and has been absorbed, and there's not a lot of new supply following it. And so that's a great question, Josh, is because everything that's in, just like any market, supply and demand controls everything. And so if you buy into a market and there's a massive amount of supply coming, your occupancy is going to go up and your rents are going to go down. It's just it's a numbers game. And so when you now look at the amount of new starts, like the deal we're buying right now, there's no new builds coming for the next 2 years. Zero. And we already have 93 to 96% occupancy. So, and we know there's job growth and population growth in the submarket. So again, with that data there, those are the fundamentals of where are people moving, how much new product is coming, and what's your competition going to be like in the coming years. And you can find those submarkets where you've got 93, 94, 95% occupancy or higher, and not much new product following because it's not able to be built in this submarket due to restrictions, due to the land. You're very likely going to see pressure on rents up purely due to supply and demand.
Yeah, I think Plano, that has some major data centers coming in, doesn't it?
Yeah, it's on fire for new jobs, new organizations. It's a place you want to be.
It's interesting. What part of the country are you out of?
So I'm up in Washington State. I grew up in Minnesota. My business partner's in Minnesota, but our team is located in Dallas. Granite Towers has 18 team members, and the majority of our team is right on the ground there, local to Dallas.
Very cool. Got it.
Yep.
So yeah, then you all are seeing deals just like we are, straight from banks or from brokers that are off market, and
Yep.
that's the other thing is relationships. If you were able to establish relationships with brokers throughout the, say, call
Mm,
it the last 5 to 10 years,
mm.
and you've proven that you're not out, you don't have any deals that are going sideways. I mean, the opportunities are endless right now to
Yeah.
just.
Yeah, that's a great point, Josh. One major factor that helped us, get this deal awarded was the brokers that are local to Dallas that we've done deals with in the past, the Marcus and Millichaps, Bricadia, JLL. And if you've got a reputation and a relationship with some of those folks where you've previously closed, a letter of recommendation from them to help, you win a deal is super powerful. And most of the time, those guys are willing to write up exactly how it was for them. And if you had a positive experience and you really excelled in one area, those can be the separator, when people are looking at who to buy from. And, it's interesting in this market, best and final, there were four groups in best and final, and three of them were family offices. And, I guess I'd consider us a family office as well, in the sense that Mike and I are here. Mike is my co-founder of Granite Towers. We're investing our family's money in every deal we're buying. And so I guess you had four family offices after it, which is, different from years past.
So are you all an operator as well?
Yeah.
How are you all structured?
Yeah, you bet. So the way we'll bring in deals is when we go through due diligence. We just were on due diligence yesterday. We'll have all of our team members there from Granite Towers with a very clear business plan of what we want to do based off of the competition. And then our vendors will come in and they're going to check two parts. They're going to check the interior and exterior of the property as what's needed for deferred maintenance. And then they're going to give us bids on our business plan. So those two pieces come together before you close a deal, and you have pretty dang good clarity of what the asset needs for deferred maintenance and what your capex is going to cost. And as long as you build that properly and with real quotes, real vendors, people you've got relationships with, now you can go into the deal with all of that built into the underwriting. So you don't have these surprises. You can come in capitalized. Then day one, when you hit the ground running, now you've got your cash ready to go. You take care of your immediate repairs, obviously your lender repairs you got to do. You take care of any of the stuff that's dangerous, and then you start with your lowest hanging fruit to start adding value based on the market. And you should know that market by the time you close better than anybody, because you've been secretly shopping all these competitors, and you've got a really good look as to what everyone's doing versus what you're doing.
Yeah, and like you'd mentioned earlier, if you can one up your competition, I mean that's just driving you into the future of just stabilized occupancy, a greater tenant base, and being that desired community that other tenants want to come to.
Yeah,
That's
that's such a good point. And the piece I would add to that for your listeners is make sure you're not over improving your asset. So when you buy into a submarket, you got to know the median income of that submarket. This submarket we're buying is 105,000 1 mile median income, and the homes in the area are about 800,000. So it's very difficult for folks to come in and buy a home, but they can rent in a unit and attend these school districts. So when you're upgrading your unit, make sure there's enough residents in that submarket that can pay for your upgrade. Don't over improve, otherwise you're just spending cash on a property you're never going to see back.
Yeah, and that's derived from your median household income and truly what people are not even being able to afford. What can they truly pay for? It's they might like the granite, they might like this, that, the things, but is there enough cash flow for them to actually pay for it from their budget? So yeah, I totally agree. That's and then that directly affects your NOI, and then your value to your investors.
Yes.
For sure.
Yeah.
What are some learning lessons that the listeners can take away of your journey in real estate?
Oh man, so many. I look back at my snowboarding career and I see how it correlates to my real estate investing career. And, just like in my snowboarding career, from being nobody to being nominated #3 rider in the world by Snowboarder magazine and my peers, there was a lot of pain. There was a lot of setbacks, a lot of injuries, a lot of things that I didn't expect. And so as we transitioned and started building our company, we started Granite Towers in 2017. So we're just in year 9 here right now, but had several properties before that. I had 60 units before we even started our company. But some of the biggest lessons I've learned is cycles control everything. Cycles are so important. And the piece with cycles that is nice to hear is you may not know exactly where we are in the cycle, but you know about where we are, right? We can see that we know the peak without a doubt was 21 and 22 in multifamily. And we've had 4 years of down, and things over the last year are starting to stabilize. And so we believe we are bottoming, and that with what rates are doing, with the way that the supply is being absorbed in our submarkets, that this is this unique window of buying opportunity. Expenses are still high, rents are low, cap rates are high. It gives you this moment based on the data that we can say, okay, fundamentals are looking great. Where are we in the real estate cycle? Okay, real estate cycle very likely bottoming or potentially already starting to recover, in 2026 here. So that's where we're at with it. And the biggest lessons though really are get your data right, get your clarity on where you are in the cycle, and then your fundamentals. Focus on your fundamentals for underwriting. You got to have the right data. And if you're not getting the right data, you're going to have pain in the future.
My screen just went. And I think a lot of operators, are you still with me?
Yeah, I'm here.
Sorry about that. I think a lot of operators got hoodooed on 2019 because they thought that was the top of the cycle, top of the market. And it was, but then there's so much cash injected into the economy that the real estate just skyrocketed. And now we have a whole new basis that's set.
Yeah. No one could have predicted COVID, right? I mean, I don't know anybody who said, "Oh yeah, we've got a huge virus that's going to completely take out the world coming in 2020," and then the response of just throwing money at the world. No one predicted that, and when that happened, it put asset pricing on a whole new level. The other piece that I think is really important to learn and to hear from experience is know your tenant profile, know your resident profile, know who's living on site very, very well, because they all are going to respond differently when things get challenging. And some of them have very low levels of integrity, is the best way I can put it. And it makes it very difficult to manage. So if you're going to buy in rough locations, lower income demographics for some demographic profiles are very challenging. And if you're great at that, what an opportunity. And if you're not, be very hesitant on taking over an asset just because it's cheap. You don't want to buy deals because they're cheap. That's not where if that's why you're buying it, you need to get more education on why you're buying, because a cheap property with a tenant profile that doesn't pay is actually, you may be overpaying, if that makes sense. You look at one 200 unit property and it's 15 million, and you look at another 200 property and it's 30 million. Just because one's worth 15 million doesn't mean it's a better buy.
Yeah, that's a great point. And there was as words used, if it's easy to get into, it's hard to get out of. And the cheaper property is easy to get into, less money required, but it also convenient. It's harder to sell, harder to get out of too on the backside. One more piece: where are you all at with AI, and is it affecting your business? Are you utilizing it, and where do you see it going?
Yeah, that's such a big topic that we're discussing literally weekly. We have created an AI bot to help us reach out to investors that we don't know well, and that's through a list. And that AI bot is literally designed with all of our information of the last 15 deals we've done and who we are as a company, and it's high net worth investors. The other piece, that we're talking about is, we were just on site yesterday shooting a bunch of due diligence, and one of the filmers there was said that they have now been able to create clones of you. And so that's obviously a bit uncomfortable and new and interesting to think about. But if the person is able to bring great information at a faster pace than someone like myself, is that something that could be used? Obviously, the talk of all of these different programs. The challenge we're coming up to is saying, okay, what's our hedgehog concept? What are we the best in the world at? Okay, we got that clear. We know what we're focused on to be the best in the world at, which is value add B class properties located in specific submarkets in Dallas and Nashville. Now, what AI software is the best for us to be the best? And instead of going really, really wide, it's narrowing it out to say, yeah, this has worked, and finding people that actually can perform on what we're looking to be the best at. That's some challenges.
Yeah, it's only going to get better. Today's the worst day for AI. Tomorrow will be better. Next day, next day, next day.
Yeah.
And then we've got the whole humanoid bots that are coming in hot. And that's going to be a game changer too, as far as boots on the ground. And it's not science fiction. It's happening. It is absolutely happening.
Yeah.
There's their figure is contracted in with Birchfield to test their bots as maintenance techs.
Really?
Yeah, so your maintenance techs will wear vests, wear the glasses, and it's ingesting data to
Wow.
learn the movements, learn the things. So
Wow.
it's going. I mean, it's coming in. So we'll just got to be prepared and be able to adapt and be a part of the thing.
Yeah. No, that's
So,
interesting. I'd love to learn more about that. That's the piece that, Elon's talking about, is by what, 2040, there will be more robots than humans on planet Earth. If that's
yeah.
true, we'll see what that does.
Yeah, I believe it. Very cool. Dan, if a listener wants to get a hold of you, reach out to you, learn more about yourself, your company, how can they get a hold of you?
Yeah, just go to our website. It's granitetowersequitygroup.com. Granitetowersequitygroup.com. There's a contact us form. Put your information in there, and happy to hop on a call, see if we can help you out.
Awesome. Dan, definitely appreciate your time and your insights. Thank you.
Thank you.